All right, welcome. Today, we're going to tackle a question that for the longest time seemed completely impossible. How do you actually put a price on the future? This is the story of financial options and the incredible intellectual journey to figure out how to value something that is, by its very definition, unpredictable. It really all boils down to this one single fascinating question. If you have the right to do something down the road, like, say, buy a stock at a specific price, what is that right worth today, right now? This is a puzzle that stumped some of the smartest people in finance for decades. Okay, so first, let's just do a super quick recap. A financial option, it's really just a contract. A call option gives you the right to buy something, like a stock, at a price you both agree on. A put option gives you the right to sell it. And the key phrase here, the thing that makes it all work, is right, but not the obligation. You don't have to do it. And that flexibility is exactly where the value comes from. And that right there, that's the fundamental problem, isn't it? The value of that contract is totally 100% dependent on where that stock price is going to be in the future. But that future price, it doesn't exist yet. So how in the world are you supposed to put a fair price on that option right now? Well, the first big breakthrough came from doing something kind of radical. They simplified the problem. They really simplified it. Instead of imagining this infinite number of things that could happen in the future, they asked, what if we just imagined two? And this gets us to the core idea behind what's called the binomial model. Okay, let's walk through this with a really simple example. Let's just imagine a stock, and right now, today, it's trading for 20 bucks. Now, get this. Here's the big simplifying assumption of the binomial model. We're just going to say that in 3 months, this stock can only be at one of two prices. No ifs, ands, or buts. It either goes up to $22 or it goes down to $18. That's it. Just two possible paths for the future. And believe it or not, that one simple assumption totally unlocks the whole puzzle. The logic here is just brilliant. First, you map out what the option would be worth in those two possible futures. Then, and okay, this is the really genius part, you build a special portfolio, a mix of the stock and the option that's perfectly balanced. So perfectly balanced, in fact, that it'll be worth the exact same amount of money whether the stock goes up or down. And just like that, you've engineered something with zero risk. And since it's risk-free, we know exactly what it has to earn, the risk-free interest rate. That certainty lets us work backwards and solve for the one thing we don't know, the option's price today. This whole process leads to this really profound idea, which is captured perfectly in this quote. To price an option, you can just pretend. Pretend you're in a risk-neutral world, a world where nobody needs extra money to take a gamble. And in that make-believe world, the option's value is simply what you expected to pay off in the future, brought back to today's dollars using the safest interest rate you can find. It's this super powerful mental trick that just makes all the impossible math suddenly possible. So, the binomial model? It was a fantastic start, a huge leap forward. But, the real world doesn't just have two paths, right? It has, well, kind of infinite paths. And the next leap forward, the one that won a Nobel Prize, is the one that tackled that infinite path future. And this is where you can really see the conceptual leap. The binomial model thinks of the future as a series of separate, distinct steps, kind of like climbing a staircase. The Black-Scholes-Merton model, on the other hand, sees it totally differently. It assumes that stock prices move continuously and randomly, much more like a flowing, unpredictable river than a rigid set of stairs. Okay, so that new assumption leads us to this, the famous and, kind of scary-looking Black-Scholes-Merton formula. But hey, don't worry, we are not about to do a math lecture. The magic here isn't in actually solving it. It's in what the formula tells us we need to know to get an answer in the first place. Because this is where you see the model's real magic. It takes all that crazy complexity and boils it down to just 5 things you need to know. The stock's price right now, the option's strike price, how much time is left, the risk-free interest rate, and one new crucial ingredient, the stock's volatility. Basically, how much does it tend to jump around? That's literally it. You plug those 5 things in, and out pops a price. And you'll notice, just like that first model we talked about, Black-Scholes is also built on that same powerful idea of risk-neutral valuation. It works by sort of pretending that investors aren't demanding extra money for taking on risk. It's this clever little trick that lets the model avoid having to predict the future, and instead lets it calculate a single objective price. Okay, so we have this beautiful, elegant, Nobel Prize-winning formula. It seems like we've solved it. But of course, this is where models crash into reality and things get a little messy. You see, the Black-Scholes model kind of lives in this perfect theoretical world. It has to assume a bunch of things, like that volatility is constant, interest rates never change, there are no trading costs. You get the idea. Now, some of these you can kind of get away with, but one of them is a really big deal. And yeah, you guessed it, that's the big one, volatility. The model just assumes that a stock's jumpiness is fixed and known for the entire life of the option. I mean, just think about it for a second. Is the market's level of unpredictability ever really constant? No way. Of course not. It goes crazy during a crisis and gets super quiet in calm times. And that's exactly why the story couldn't end with Black-Scholes. Newer, more advanced models, like one called the Heston Model, were built specifically to fix this problem. They actually treat volatility itself as a random, unpredictable thing that changes over time, which, let's be honest, is a much better picture of how markets really work. So you might be asking, if the models aren't perfect, what's the big deal? Why are they so important? Well, it's because their impact went way, way beyond just some formula in a textbook. These ideas literally remade the world of modern finance. This quote right here really gets to the core of it, the idea that you can actually combine different risky things to create a position that has no risk. This concept of dynamic hedging was absolutely revolutionary. It's the engine at the heart of all financial engineering. That one intellectual framework, it became the literal bedrock for the entire global derivatives market. And we're talking a market now worth hundreds of trillions of dollars. It's the logic that allows for the pricing and managing of this unbelievable range of financial products. And the real-world impact, it was just explosive. These models gave everyone a standardized way to price options, which let the market for them just blow up. It made it possible to create all sorts of new, complex financial products. It gave companies incredibly powerful tools to manage their own risks, whether that was currency swings or changes in interest rates. Basically, it gave everyone a common language to talk about value. Which kind of leaves us with one final big thought. These models were without a doubt a monumental achievement. They gave us a framework, a language, and tools to put a price on uncertainty. But you have to ask the question, even though we can put a price on it, can we ever really truly tame it? And that's something worth thinking about. Thanks so much for joining me.